experts, great questions.
This is the countdown to the open. I'm Danny Berger in for Jonathan Farrow. We're moments away from the start of trading, and if you thought stocks couldn't climb any higher after yesterday's record across the board, here we are. We're up about 1/3 of 1%. NASDAQ futures, S&P futures, even NVIDIA is higher yet again. Maybe we've underestimated just how much can be priced into this stock. Unfortunately for small caps, they are still down. They're not joining the party. When it comes to yields, those are also taking a breather. Bonds, not too much action today after hitting another year-to-date highs yesterday after Fed speaker saying be cautious when it comes to pricing in cuts. Your euro versus the dollar slightly stronger. We're headed on track for the dollar's first down week to start the year. NYMEX crude down lower by 2% after the U.S. unveiled more sanctions against Russia. Some nerves. What does it mean for global trade? We'll get into that later this hour, but $76.90 a barrel. Now, one stock to watch at the open, it is Carvana. The used car retailer's profit did top expectations in the final months of 2023. Abigail Doolittle has more. Hey, Abby.
Hey, Danny. And the stock is absolutely soaring, up about 30%, heading to its best day since July of 2023. But let's put this move into context, because this stock was down about 99% between its 2021 peak, when it was several $100s high, to its 2022 trough at a single-digit number on going concern fears and debt issues. Now up more than 1,300% off of that low into today. So I think that there's a lot of relief here that this company is still around, that they're performing well. EBITDA of $60 million, not a huge number, but better than the estimate of $58.6 million. Looking past the fact that revenue was just a little bit light. And it's the forecast that investors like a lot too, suggesting an improvement for both earnings and the number of cars sold. I was mentioning that the last year has been one of retrenchment and debt reduction. Cash burn is important to watch as well. Interestingly and importantly, the company's gross profit per unit rose to more than $5,500 from just above $3,000 in 2022. So they are doing well there and showing through into that EBITDA. I mentioned before, though, there's something else going on here. There is a bear short interest of about 32%. So some of today's now 35% move, well, some of that's a bear short squeeze, Danny.
Yeah, a little bit of a squeeze to that flavor. Abby, appreciate it. Now, another big beat this morning coming from Block. The payments company exceeded expectations with both results and first quarter guidance. Katie Greifeld has more. Hey, Katie.
Hey, Danny. Block absolutely soaring after that beat and raise quarter. You look at cash as specifically, revenue there rose 31% from a year earlier to $3.91 billion. That is topping estimates of $3.7 billion. And the big headline was that outlook. The payments technology company raised its forecast for adjusted EBITDA to at least $2.63 billion. The previous guidance was $2.4 billion. So a lot to get excited about there. And you can see that in the sell side, broadly positive on this report. Vital Knowledge in particular calling out that the company has made significant progress on curbing costs and headcount. And remember, that's a particular focus for Block. They announced job cuts to cap the workforce at 12,000 employees. The firm aims to reach that goal by the end of the year. And we got some interesting comments from Jack Dorsey on the topic. He said that we're going to operate under this cap until we feel it's holding us back, which is likely years out, and continue to look critically at our organization and priorities. Traders clearly liking that discipline. Again, the stock up about 19% at the moment.
Katie, appreciate it. Now, they can't all be good news stories, right? It's a different outcome this time for Warner Brothers Discovery. The entertainment conglomerate's revenue missed estimates. Sorry, Simone, you got the one stock that's not up double digits. Simone Foxman has more.
No, not up double digits. It's actually hitting a record low here this morning after the company missing estimates. Revenue coming in at $10.3 billion. The expectation had been for $10.5. All of this mainly driven based on misses in advertising revenue, down 14% year on year, especially in the company's TV division, seeing a loss per share of 16 cents versus the 6 cents that was anticipated, feeling the impact of those recent writers and actors strikes. There actually were some good bits of news in here. Total subscribers surpassing estimates at 97 million, topping expectations on cash flow, and the company says it is on track for $1 billion of EBITDA in 2025 for its Max streaming platform. In fact, David Zaslav, the CEO there, also talking about healthy traction in advertising in the first quarter that they expect to continue over the near term, with a focus focus really is on the near-term challenges. That's something that Deutsche Bank highlights, Bloomberg Intelligence saying the company just has a $44 billion debt burden, and that makes any M&A from here very difficult. Do we see a floor today? Certainly negativity, the name of the game, though, with shares down now over 12%, Danny.
Simone, better luck next time. We'll get you a positive story next week. Simone Foxman there. Now, we're also watching NVIDIA. It's in the green again. It's hitting a $2 trillion market cap. It had a record session yesterday, adding $277 billion in market value in a single day. That is bigger than the market cap of Netflix, of Pepsi, of Bank of America, just to name a few. It is almost like a country on its own. Alex Webb joins us now for more on this. Alex, I mean, what's going on? It's up 4% again today after 16% yesterday.
Yeah, it's quite astonishing to think that, just 6 years ago we were writing about how Apple's the first $1 trillion market cap company in the world. Now we've got 4 of them. We've got Apple, we've got Microsoft, got Saudi Aramco, and now NVIDIA. The real thing yesterday, of course, we had the earnings. There was good news in the quarter that was being reported. There was good news in terms of the outlook, both of which massively exceeded the market's expectations. But perhaps more significant than that were the comments from the CEO, Jensen Huang, about 2024 and 2025. Because the company only forecasts 1 quarter in advance, that can sometimes create a little bit of skittishness among the investor community about how long this role can last. How long can they continue to grow at this extraordinary pace? Jensen Huang said that the growth trajectory is likely to continue at the similar level for the next year, 18 months. That is something clearly that provided a great deal of relief to investors and is one of the big factors driving this massive resurgence in the share price.
And literally all the share prices with records across the board. Again, we are trading at another intraday record in the S&P right now. Alex, thank you so much. Now, Chris Morangi of Gabelli Funds weighing in on NVIDIA, writing, AI is transformative in a way we can't predict. We're looking for businesses that can reduce costs and increase output using AI. NVIDIA, one of the clear winners, able to monetize the boom, which is why it added $250 billion in market cap. Don't fight it. I'm pleased to say that Chris joins us now. Chris, again, it's remarkable to see, again, $250 plus of market cap added on yesterday. It's up another 4% today. The thing is with this stock, it seems like investors were caught off guard with how good the story is. We talk about regulators being behind on AI. Are investors behind on AI? Do we truly comprehend the potential of a company like NVIDIA?
Well, we're clearly in an era of enthusiasm. We're just beginning to think about the effects of AI, and there are very few ways to play it, very few clear ways to play it, and NVIDIA is clearly among the best, and that's why everybody's jumping into this one. So a lot of work to be done. I haven't attempted a DCF on NVIDIA, the market opportunity. Nobody knows how big it could possibly be, but it's early, and that's why we're not fighting. We don't own it, but not shorting it, certainly.
When you do make that DCF on NVIDIA, please feel free to send it our way. I'd love to see how you even attempt to do something like that. But given that, Chris, given it's again, you got to be creative in thinking what NVIDIA can do. What do you do after a day like yesterday? Do you try to buy up some NVIDIA?
No, we don't. We're focused on our areas of core competency. That doesn't really include semis. We're focused on industrials, consumer, in some areas of financials and healthcare. We're looking for companies that have moats, that have pricing power. They tend to be smaller areas, companies where we can have an edge. And those have largely been left out of the market over the last several years. We saw a little bit of a rotation in the fourth quarter last year. That's been put on hold clearly, as NVIDIA has taken all the air out of the room. But we do think that will resume if we get a soft landing kind of scenario.
Chris, I read that quote from you earlier, just saying that, look, we're looking at companies that can reduce costs and increase output by using AI. Morgan Stanley had a piece out earlier in the month saying that companies are mentioning efficiency and AI together in one breath like they never have before. But how do you disaggregate what companies are actually doing that and those that are just using AI as an excuse to really try to hammer in on costs and let staff go?
Yeah, I mean, it's a great question and something our analysts are focused on. It's a question on almost every meeting that we have with companies. And, we've had a few over the last few weeks where, and I won't name the companies that are, using AI to do coding, to do content production, et cetera, in areas where I'm focused on, and particularly in media. So, this obviously was a big issue in the actors and writers strikes that you mentioned earlier as the source of some of Warner Brothers' troubles. It's going to be used in very game-changing ways, and our job is to figure out how that impacts earnings.
Chris, I feel like you were one breath away to being like, Danny, I talked to your boss about it, and you're about to lose a job because AI is going to be the next anchor of the Open, which, fair enough if it did happen. But I know you like live entertainment and sports, as you mentioned, and you've been talking clearly to companies. Again, I wish you'd tell me which one. But do they have it right yet? Do you think they have the mix right yet of getting AI to contribute to content? Because there are always, people who say that they're going to use this new technology and get really bullish about it, and then it ends up not being there yet.
Well, one of the reasons that we like live entertainment and sports is because it's very hard to replace those elements with AI. And there is still obviously a deep human need for contact, for being together. It's in part why you're seeing, the concert business generally up 20%. Another stock that is doing quite well is Live Nation, which reported last night. They're indicative of that, as well as some of the other ones that we own, like the Sphere in Las Vegas, which has gotten a lot of attention. Again, human experiences, physical experiences, difficult to replicate. The secular trend that started before COVID has been accelerated by COVID and continues today.
Do you think this market is too hypnotized by the flashy objective, not the tangible physical things, but by the tech companies?
Yeah, there's always a shiny new thing, and clearly we've landed on the shiny new thing being AI, and we're in a hype stage. And at some point, then we'll get some retrenchment. That's probably the time to make some investments for us. But, we're, again, focused on companies that have been making products for decades that are durable.
Mm-hmm. And, Chris, as you're talking, there's a screen right next to you that shows the S&P at another intraday high, NASDAQ up 0.4%, small caps down 0.2%. We saw a similar dynamic yesterday where we saw the S&P 500 up by 2% and small caps not even up by 1%, just under it. You say that short term there's going to be rotation to small cap and value. Chris, I got to be honest, I heard that at the end of 2023 also. What's different this time?
Yeah, I don't know if I guess it depends on your definition of short term. Clearly AI, large cap, mega cap is winning the day, but eventually the value gap is just going to is too great. And you've got the small cap stocks, the Russell 2000, in a bear market, and it's been very rare that that's happened alongside the S&P at all-time highs. So the value gap is just too great. And again, if we see a soft landing kind of scenario and lower rates, those disproportionately help some of the more cyclical companies in the small cap indices and the companies that we're focused on.
Chris, you also write that political risk is likely underpriced. This is something that a lot of people are trying to wrap their heads around. Do you need to have a portfolio that trades for Trump 2.0? What do you get ready to do if Red Sea continues to flare up? So what is this market missing? What is currently underpriced for political risk?
Yeah, I think we'll probably see more volatility in the market as we get closer to the election in the U.S. Obviously, you've got the international dynamics and at least three major hotspots outside the U.S., but then we've got our own hotspots here. And, there are at least two elements. There's one, can we conduct a free and fair election in this country where we have a definitive winner on November 6th? And then secondly, what are the policy implications from a change in occupant in the White House, if that's what's going to happen? And I'm not sure where the market lands on that. There are clearly some reasons to be bullish for Trump, probably more pro-growth, but some questions around trade stance and just the overall stability of the economic and political system in this country. So all to be determined. The market hasn't really focused on it, probably will focus on it and more. And that's why we think there'll be more volatility, probably more opportunities to get into this market as we go through the year.
Yeah, I guess if anything, we're all looking to buy the dip with $6 trillion in cash at the moment. Chris, really appreciate your time. Enjoy your weekend. That's Chris Marengi. Now, coming up, Russia hit with significant sanctions.
Important to remember that our objective remains the same, going after Russia's military-industrialized complex and their ability to earn money to prop up their economy and buy the goods they need to fight the war they want.
We'll have details on the targets and the implications next. This is Bloomberg.
Important to remember that our objective remains the same, going after Russia's military-industrialized complex and their ability to earn money to prop up their economy and buy the goods they need to fight the war they want. What we're doing today is we are furthering those actions by going after companies in Russia that are helping to build military equipment. Today, Russia's running a wartime economy. Factories that used to produce goods for Russian civilians now are producing military equipment. We're sanctioning those companies, but we're also going after the companies that supply them in third countries in order to make clear to companies in third countries that you have a choice. You can do business with Russia and their military-industrialized complex, or you can do business with the United States and our allies and partners who are joining us in this effort.
The U.S. issuing a raft of sanctions against Russia following the death of opposition leader Alexei Navalny. Those include a military drone manufacturer, a payment system, and a 3D plastic printing company, as well as numerous others. Bloomberg's Anne-Marie Hordern joins us now for details on them. Anne-Marie, how much of this is symbolic versus impactful?
A lot of it is symbolic because you have to think the Russian economy already has a tremendous amount of sanctions on them. This has been levied throughout the past 2 years. We're coming up on what would be the next third year going into Russia's invasion of Ukraine starting tomorrow. But with the death of Alexei Navalny and on the anniversary of Putin's invasion, the U.S. is making a statement. So it's the biggest in terms of how many people and individuals, more than 500 in a single day. There's also TMK, which if you watch Russia is a well-known pipe producer. So some important names here, but you have to remember, of course, that what President Biden promised, which is that he'd turn the ruble into rubble and that he'd halve the Russian economy, Putin hasn't been able to defy projections. The IMF has lifted Russia's growth prospects for this upcoming year. So yes, it's more sanctions, but will they work and change the trajectory of this war? No.
What else can the U.S. do at this point when it comes to sanctions?
Well, it's a great question. They can go after secondary sanctions, and potentially we might see some of that in this package. So companies that are trading with Russia, that would go against U.S. sanctions. We've seen Europe want to take this path forward as well. Also, one part of the Russian economy that has been insulated for the most part, except in the United Kingdom, has been metals, aluminum and nickel. And we asked Wally Adeyemo, the Deputy Treasury Secretary, about this during surveillance, and he basically said, wait and see. So it does seem like that is potentially going to happen. If you look at what's happening in the trading markets, nickel and aluminum are higher, so they also are expecting some sort of move from the West on going after those metals as well.
Meanwhile, over in D.C., we're about a week away from another government shutdown deadline. Anne-Marie, how down to the wire does it look like it's going to get this time?
Surprise, surprise. Well, they have about 2 days to get it done if they want to hit that first deadline. So the way Speaker Johnson was able to sell this to some of the members of his caucus who really don't want to do deals with the Democrats in terms of trying to get something over the finish line and are being hardliners on this, he has 2 tranches. So some parts of the government would shut down if they didn't come to an agreement March 1st, and the rest would be March 8th. So you hear a lot of analysts talking about potentially there's a small shutdown on the 1st, but then they have this deadline of the 8th for remainder that they package everything in. They can also punt it. We've seen this game a lot in Washington, D.C. Just keep kicking it down the road to potentially another continuing resolution. The issue then is the Freedom Caucus members may say, Speaker Johnson, we're going to go after your gavel the same way we went after Speaker McCarthy's if there's a continuing resolution or if he does a deal with the Democrats. Either way, he's going to have to do a deal with the Democrats to keep the government open or shut into a continuing resolution or continuing resolution. There's potential for him to lose his job in all of this.
I mean, those are literally so many different outcomes that might come from this, Anne-Marie. Do you think that this kind of idea of having to break it up into 2 different deadlines, if it is punted, does it continue to look like that? It's getting increasingly messy if that's even possible.
Yeah, we've seen this 2 deadline approach happen for the last few months. Every time there was a continuing resolution, they then punted it, but still had dual deadlines for some parts of the government agencies on the first date, some parts of the government agencies on the second date. So that I would expect to remain the same. The issue is they are getting very close to the November election. So a lot of people are going to want to, and primaries as well. So a lot of people are going to be hardening their policies. So some of these votes may be difficult.
Yeah, I hear there might be a primary this weekend, or there definitely will be. Anne-Marie, thank you so much. Anne-Marie Hordern. All right, for some of the sector price action this morning, let's get over to Bloomberg's Abigail Doolittle. Hey, Abby.
Hey, Danny. Well, we are looking at pretty bullish sector composition. Most sectors are higher for the S&P 500, supporting that gain of about 0.4% up top. Tech, NVIDIA, chips, technology in general doing well, up about 0.9%. To the downside, we do have energy, though. So let's stick with this sanction story, down 1.5%, because one area that Russia has not sanctioned, or the U.S. has not sanctioned against Russia, as you were just mentioning, oil or any of the other commodities. If you recall, back in 2018, strict sanctions were put against Rusal. At that time, aluminum spiked about 39% in a very short period of time. But right now, the commodities complex has not been sanctioned. It could be, as Anne-Marie was just talking about, but we can see Brent crude down 2%, the Select Spider ETF that we were just looking at down 1.5%, the worst sector on the day. The overall Bloomberg Commodity Index down 1%, and then we have methanol futures, which are up just a little bit relative to aluminum, which is not on this board, down about 0.8%, copper down 0.7%. So it's going to be interesting to see in coming days, Danny, how this plays out, because right now investors in these commodities really not pricing in some sort of sanction activity against commodities, but as we know, that could change instantly.
Yep, we've seen that before. Abby, thank you very much. Now, coming up, we're going to look at the market-moving events you need to be watching. That's up next in our Trading Diary here on Bloomberg. Let's get to your Trading Diary. Coming up on Saturday, Nikki Haley and Donald Trump face off in the South Carolina primary. Monday, we're going to get new home sales data. Then Tuesday, we have a slew of retail earnings. Those include Macy's and Lowe's. On Wednesday, we'll get U.S. GDP figures. Then on Thursday, it's the PCE deflator, so maybe some more macro volatility. In the meantime, equities yet again at all-time highs. The AI party continues. That was the countdown to the open. This is Bloomberg.
30 minutes into the U.S. trading day on this Friday, February 23rd. Here are the top stories we're following. Records on records. Stocks around the world hit all-time highs as the global rally rolls on. The S&P 500 hit yet another record this morning, fueled in part by, you guessed it, NVIDIA. Set to become the first chip maker to hit a $2 trillion valuation in a milestone for the semiconductor industry. We'll discuss how that's shaking up the ETF world in today's ETF Friday. And bookings, bad day. A disappointing forecast for room reservations sends shares spinning, with the war in the Middle East weighing on results. CEO Glenn Fogel joins in just a bit. I'm Katie Greifeld in New York. Welcome to Bloomberg Markets. And you take a look at markets on this Friday, and you can see we're still green, at least when it comes to the S&P 500 and the NASDAQ 100, but much quieter than what we've gotten accustomed to. The S&P 500 up slightly this morning, breaking above 5,100 for the first time ever. You take a look at big tech, the NASDAQ 100 trying to hold on to gains here, currently up about 0.1%. Of course, we'll see how that settles up. And I did want to take a look at the Philadelphia Semiconductor Index. Of course, we've been talking about NVIDIA so much this week. That's really been boosting this entire index as well. But you can see taking a bit of a breather on this Friday with the stocks currently off by about 0.5%. But let's get more details on the composition of this record run. We're going to do that now with Abigail Doolittle.
So, Katie, not only was yesterday's record high really memorable because of the run, the blowout move to the upside by NVIDIA, but it's also because it was a 2% gain into a record high. That's a relatively rare event. We do have typically you take the stairs higher as opposed to leaping higher, but here you have a greater than 2% move up into that record high. Let's break it down what this has meant in the past. And I would say overall it's tended to mean that you're going to have some sort of a correction or even a major top, but the timing is tough. So you can see back in September of 1929, there was a 2% move made into a record high. We did, of course, have that crash not so long after. In the 50s, more than a year ahead of that, there was a 20% correction. In 1980, right ahead of a 27% move, there was a 2% move higher. And then ahead of 1987, there was a 2% move higher in 1987. In the early 90s, not so much. And then you can see this happen several times ahead of the tech bubble. So I think that it speaks to exuberance, not taking that stairs up, not the most stable foundation. But as we can see from history, timing's very tough. At some point, we're probably going to see some sort of a real reaction to the downside out of these highs, but we just don't know when.
All right, a great wrap up there by Bloomberg's Abigail Doolittle. Thank you for that. And let's get more on these markets now with Ankur Crawford, Executive Vice President and Portfolio Manager over at Alger, joining me on set. Great to have you with me. And I'm excited because I take a look at your notes and you declare that it's no longer the Magnificent Seven, it's the Magnificent Four. What happened to the other three?
Yeah, so as we go through this next technological revolution that's going to be driven by AI, there are some companies that are leading that charge, and there's some that are, I would say, technologies that either need to develop into this new industrial revolution, or they're going to be left behind. So you take Google, for example. Google's business, I would say, is an existential risk that search actually changes over the next decade with AI. And so it kind of drops out of the Mag 7. Tesla is going through a pause right now. We'll see where they land in terms of AI and moving this charge forward.
I have to say, when it comes to Google, it feels really hard to bet against Google. I'm sure they're in catch-up mode right now, but do you have enough conviction there that you would sell Google or just simply not add to that position?
Yeah, I think that it's all opportunity cost of what's going to outperform. And as of right now, because we don't see Google making the necessary steps forward to not only protect their search franchise, but also to grow their business inside of AI relative to the other players. It's more of an opportunity cost. Would I rather have our capital in NVIDIA or Google?
Mm-hmm. And Google or NVIDIA, yeah, that is the big question. But you talk about the existential questions that are facing the search business at Google. Who benefits from that? Are we talking about Microsoft's Bing or someone else?
You know, I think we are so early in this cycle. And it is unclear who the winners will be. Microsoft, clear beneficiary in search if they can get Bing to start to work. But, you know, Perplexity AI is a new vendor that is sourced on basically an open stack. I use it every day, and it's phenomenal. So it's a different way of searching that is not yet ad supported, but will be, and it's a better way to search.
So I feel like when we're talking about Microsoft, what NVIDIA is sort of billed as, and I think the reason why people are so excited is that it's not necessarily picking a winner from who is going to best monetize AI, but NVIDIA, of course, makes the picks and shovels that really fuels all of this innovation that we're seeing in AI. And as you said, it's too early to pick winners, but when it comes to the strategy of selecting parts of AI exposure that you want to have, I mean, is it the picks and shovels at this point, or is it the companies that are actually putting AI into practice?
I think it will be both. So you take a look at our top two positions, it's Microsoft and NVIDIA. NVIDIA is the picks and shovels that will benefit from the CapEx cycle that we're embarking on today. Microsoft is the enabler. They offer the co-pilots. And it's not only confined to Microsoft. There's a lot of different companies, whether it's ServiceNow, Adobe, although it recently got dinged by Sora. So there is the enablers of the technology that will have pricing power as we go through the cycle, where you can also invest. And they will be the winners. And in part because these are businesses that are now platforms. They're not point solutions. And the platforms in this cycle are going to be at a structural advantage relative to point solutions.
And so we're talking about fundamentals here, and clearly you see a big trend underway, a big cycle coming up when it comes to these tech names. But how are you putting that against valuations? Because a lot of people love to throw around the word bubble, especially when you look at a stock like NVIDIA, which has just gone out a crazy amount over the past couple of years. How are you thinking about those two different factors?
Yeah, so bubble territory is not a 20, 25, 30 multiple on earnings in a market that's growing as robustly as AI is. I mean, you take Microsoft, for example. Microsoft's going to be growing mid to high teens for the foreseeable future at the size that it is today. You're paying a kind of high 20s multiple for it today. That's not that egregious. You know, that is not what I call bubble territory, and in part because, you know, you wait a couple years, it'll be a 20 multiple or 5% free cash flow yield. NVIDIA, it looks like the stock is in bubble territory, and you see all these graphs of, oh, this is what Cisco looked like in the bubble. And I wholeheartedly disagree. And in part because last year at this time, the earnings for NVIDIA for 2024 were pegged at $4. Today, they're approaching 28 to 30.
Right.
And so the sevenfold increase that we've seen in the stock, or sixfold increase, is actually off of numbers that have increased sevenfold. So the multiple from a year ago is exactly the same. So I would argue that, especially for a business like NVIDIA that is driving this forward, we're going to put $1 trillion of extra CapEx into the ground.
All right, it's time now for Wall Street Week. And the host of Wall Street Week, David Westin, he sat down with Nobel-winning economist Paul Romer to talk about the shift in global trade relationships, what it means for the U.S. economy.
I think we need a more nuanced view, and it's really one that goes all the way back to the origins of my work, distinguishing ideas from objects. And what we want to do is encourage as much flow of ideas around the world as we can, but we don't need to worry so much about the flows of objects because we don't get very much benefit out of the trade in the objects. And as I'll describe, there's some costs associated with those.
I think historically, economists have told us that free trade is really valuable to growing the economy, that you have comparative advantage in order to really grow an economy. If you actually do cut back on free trade, do you have to give up growth in the economy?
No. So you don't have to give up the growth because it's the trade in ideas which is essential for faster growth. So for example, if you got a firm that invents like a better pharmaceutical in the United States, you want them to be able to earn royalties on that all over the world because the returns to innovation will be higher and they'll discover more things. But that doesn't mean that the pill has to be manufactured in the United States. The firm can get the royalties just on the intellectual property and have it manufactured anywhere. To give you another example, during the 70s, Japan had gotten better at making cars according to these zero defect, quality control standards. And we came to an agreement with Japan where we said, Toyota, Honda, those companies, they can come and manufacture cars in the United States. So the ideas that they had developed, they could earn a profit on, and U.S. consumers could get the benefits of higher quality cars. But we still had cars that were manufactured by workers in the United States. And that's the advantage of some kind of restrictions on the trade in goods, is that we can actually protect the jobs and the incomes for the people who, unfortunately for the last 2 decades have really been left behind.
That is a perception. I wonder about that perception. There is a perception that with globalization came the loss of a lot of American jobs, a lot of particularly middle-class jobs, people who are not necessarily the highest educated workers. Is that borne out by the data? Is that really what happened?
Yeah, and I think the right way to cut it, because middle class is a very vague concept, the way to cut it is high school educated versus college educated people. And if you look at something like life expectancy, high school educated people are dying younger. They're dying from these deaths of despair. If you look at employment, the average adult, the average number of adults who have a job in the United States has gone down, mostly because the people who are high school educated have such miserable prospects that some of them have given up. The rest are staying there in the market, but they're really suffering. So life expectancy, willingness to work, these are the kinds of underlying indicators that tell us life is not getting better. It's getting worse for a large fraction of the people here in the United States. And we got to think about what do we do to give them a growth prospect like the rest of us have, the college educated have. What will make it so that they can see progress in their lives and even progress where their children will do better than they did.
So free trade in ideas, as you put it, not so much in goods. What about in capital? Because we have examples even right now with Nippon Steel wanting to invest in U.S. Steel. The U.S. government's expressed some reservations about that. Where are you on capital? Should we have restrictions on foreign investment in the United States?
Yeah, no, I think foreign investment is by far the most important vector for moving ideas around the world. There's licensing, there's intellectual property, but it's really foreign, it's firms that carry ideas. So Nippon Steel could bring its ideas in about how to make steel better, more efficient methods. That's just like Toyota and Honda had these ideas about quality control, which interestingly were ideas developed by a professor in the United States, Deming, but nobody in the United States would listen to him. So he took the ideas to Japan, they developed them, they turned out to be fantastically important, and then we got them back through the direct foreign investment by those firms. So we definitely want us both to protect our firm's ability to go earn a return in other countries in the world, But also, we want to fight for that. We also want to fight for the ability for the foreign firms that have good ideas to come and supply them to workers and consumers in the United States.
So you're an economist, of course. You're not a national security expert. How does national security cut across this potential? Because there are concerns that some investment, foreign investment, particularly from some rivals, if not enemies, rivals, into some U.S. industries, could actually undermine our national security.
Yeah. I think people are like barking up the wrong tree here. I think that what we should really be thinking about on national security is we want to make critical security technology goods like chips in the United States so that if things get really bad, we control the supply. And we want to make things like masks, like for the next pandemic in the United States. And we've gotten ourselves in a position where we are not self-sufficient in chips or masks.
And that was Nobel-winning economist Paul Romer. And sitting beside me now is David Westin, Wall Street Week host, joining us now. Really unconventional approach to free trade.
Yeah, I had not heard it before. I've done some in trade before because we typically talk about free trade or protectionism, and those are the two alternatives, right?
Yeah.
And both parties really, as Paul talked about, have moved toward the protectionist side, or not so much free trade anymore. But he's saying, wait a second, you shouldn't treat ideas the same way as goods. You can keep the goods out, keep the jobs here, but actually have the ideas flow. And as he said, it goes back to the reason he got the Nobel Prize, because his whole theory was a theory of growth that really depended on innovation and ideas more than the inputs.
Well, does this align with any one party, Democrat or Republican? Like, is either Biden or Trump campaigning on this?
Nobody's campaigning. I think it's a really good point, Katie. I will say we asked Paul about that question. He thinks the Democratic Party may be more open to it, but I haven't seen it yet in what they've said. Certainly what we've heard out of former President Trump, he's talking about with Bob Lighthizer, his advisor, is not interested at all. They really are more interested in tariffs.
More interested in tariffs. Well, we'll see if this catches on, but that was a great conversation with Paul Romer. But the big show is tonight. Who do you have coming up?
Well, we're going to continue some of the trade discussion, actually, with the former House Majority Leader. He's Eric Cantor. He's a Republican. And then we're going to go beyond that to the other difference between the parties. We'll talk to him about that. And we also have, of course, Josh Friedman. He's the co-CEO, co-founder of Canyon Partners, talking about distress investing. That'll be at 6 p.m. Eastern Time tonight.
All right. Well, really looking forward to it. It's great to see you, of course. That is David Westin, the host of Wall Street Week. This is Bloomberg. NVIDIA not only delivered for shareholders, but also for ETFs that place leverage bets on the chip maker. For more, we're joined now by Bloomberg's Emily Grafeo. Talk to me about tickers.
Well, this has been a big week for double leveraged NVIDIA ETFs. And what's interesting is that the SEC only approved these 2x NVIDIA ETFs a couple months ago, and already we're seeing massive trading volumes. You look at the Granite shares, 2x long NVIDIA daily ETF. It's a mouthful. But the ticker is NVDL. It saw record trading volumes after NVIDIA's earnings. And it's also, when you look at the broader ETF ecosystem this week, one of the biggest inflows relative to market cap. Just this week alone, it took in about $136 million. It's also one of the best performing ETFs year to date, up about 117%. The other 2x NVIDIA ETF, the T-Rex one, that's up 134% year to date, Katie.
Yeah, it's interesting that there is any difference in performance year to date between these two, since theoretically they track the same thing. But yeah, we'll dig into that off air. So like you said, this has been followed by inflows, of course, flows following performance. What about if we look beyond just the leveraged ETFs here, the shiny objects, as Eric Balchunas would say? I mean, what has this meant for semiconductor ETFs?
Well, the broader ETF ecosystem has also seen inflows when it comes to chip stocks, and I think it does really have to do with NVIDIA. If you look at the VanEck Semiconductor ETF, it has about a 25% weight to NVIDIA. It's the top holding, and that's swelled to more than $15 billion in assets. In just the last couple days, it's taken in over $600 million in flows. So there really is an appetite to get in on that trade. Hopefully, people not getting in post the performance, but good luck to them.
Yeah, we'll probably see some people buying the top, of course. It feels like we always see that in these crazy shiny object ETFs. Bloomberg's Emily Grafeo, thank you so much. Now, we take a look at markets right now, and you can see that we are looking at gains here. Of course, quiet, not exactly what we've gotten used to over the past day or so, but still highs nonetheless. Of course, you can see there the S&P 500. It did break above 5,100 earlier in the day, and we are a little bit below that right now, but hanging out around 0.2% higher. You can't say the same for big tech. Those small gains have turned into small losses. Of course, the NASDAQ 100 down by about 0.1%, and you do have small caps there. That's fun. We haven't talked about them in a while. Small caps, it's not too exciting. You can see the Russell 2000 there, currently unchanged on the day. I think it's fair to call that unchanged. Now, coming up, though, Huffington Post media founder Arianna Huffington joins Bloomberg Technology with Caroline Hyde next. That does it for us. Have a great weekend. This is Bloomberg.
where innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Caroline Hyde of Bloomberg's world headquarters in New York. This is Bloomberg Technology. Coming up, NVIDIA, it tops $2 trillion in market value, becoming the world's fourth most valuable company. Full coverage ahead. Plus, we'll break down Reddit's filing to go public, from its AI ambitions to its largest shareholders. And Sam Altman, he is omnipresent. We've got you covered. And Carvana, shares pop by the most in 7 months after the used car retailer defied challenges of higher interest rates and inflation to actually post, well, a kind of solid end to 2023. We sit down with the company's CEO. But first, let's check in on these markets, because the S&P 500 managed to break new territory. We see the Nasdaq just off by about 0.1%. But more broadly, we are seeing what's happening in terms of European bonds, as well, European tech stocks helping power up the Stoxx 600 to a new record high as well. US 10-years, we're just seeing there, off by some 3 basis points on the day. Not huge moves, but we're at 4.3. Let's move it on and have a look at some individual movers, because we are still basking in the glory of what NVIDIA did in terms of its earnings. We go flat on the day, but of course this is a company that's been managed to claw its way to a $2 trillion market capitalization. Currently, as we stand, $1.97 trillion. But we will see whether we can eclipse that all-important $2 trillion level. We have a look at what's happening in terms of going to the moon. We know that Intuitive Machines is the company that got its overall lunar participation going yesterday, landing on the moon for the first time in 50 years, a piece of tech coming from the United States. We're up 23%. We'll dig into that story a little bit later. Meanwhile, not all earnings are glorious, and Mercado Libre manages to underperform. We're up by 13%, one of the worst performers on the day, not to mention Warner Brothers, which we'll be digging into a little bit later. But first, let's just peel back all of these narratives when it comes to earnings, when it comes to the AI boom, and really decide whether there's more legs to run on in terms of this market. Erica Clara, I'm pleased to say, is with us, portfolio manager for PGIM Jennison Technology Fund. Her read on tech, on markets, on NVIDIA, of course. I mean, we look at the $1.97 trillion market capitalization. We're clawing our way to the $2 trillion mark, Erica, and I'm interested as to whether you think the hype has reality underneath it, and ultimately whether we will see a leg higher, or whether we'll see a broadening at last in terms of the AI love.
Well, to answer your question, I think yes to both. You know, Jennison has always had a very long-term outlook on trying to dimension what these opportunities are. We've always been very, very positive. We were very early in investing in NVIDIA back in 2016, and all of our expectations, even as ambitious as they were, have been absolutely blown out of the water to the upside.
I mean, Jennison is an operator. He manages to guide and then beat, and guide and beat each time, and still managed to be a global business. And I think that's sort of what's been extraordinary, that this is a company that is finding working with China more difficult, largely because of US-Chinese geopolitics. How much do you have to factor that into some of these big tech names?
Well, certainly the political landscape right now is much more challenging for companies, as they have restrictions in terms of where they can sell, what they can sell into China. China had risen to about 20% of NVIDIA's data center revenue. That contracted down to 5% in the most recent quarter. But what we're seeing is, for companies like NVIDIA, they've been very nimble, very innovative in terms of coming out with products that comply with all the export laws. Those will start to ship later this year. We believe at Jennison that there's a lot of pent-up demand from those Chinese customers that will contribute to the company's overall performance in the second half.
Let's broaden out from NVIDIA, therefore. Is there room, market share, ability and capability for the likes of AMD and some of the other rivals in the space? Should we look to other chip makers?
Our view is yes. At Jennison, we see that NVIDIA, in its own process of innovation, has opened up the doors of opportunity for many other companies, from compute companies, as you mentioned, like Advanced Micro Devices and Broadcom, which we own in size, to storage companies, to networking companies, and of course to software companies that are able to harness this incredible compute power to deliver software that enables tremendous gains in productivity and innovation.
Just going back to NVIDIA for a moment, is there anything that makes you give pause? A $2 trillion market valuation, an issue of China, or indeed of just like running out of road of exuberance, or really do you have to go back to, well, forward PE ratios that still make the company look really rather attractive and not that expensive.
Well, what we try to do at Jennison is really take a longer-term view. We've actually written some white papers that are on our website about this, but looking out over the entire TAM of the installed base of infrastructure. We see that as a $1 trillion opportunity today, but the very innovation that NVIDIA and others are bringing to the table is expanding that TAM, and we're really only maybe 10-15% penetrated at this point. So we see years of opportunity ahead for further penetration of those markets, further updating to this brand new way of compute, which is known as parallel processing.
Where else in the stack then? Because there is, if you talk to the VC community, yes, they're looking at the underlying compute and the large language models, but they're also looking at the applications and the app layer to AI. But where are you looking from an industry perspective at where artificial intelligence can bring real opportunities for productivity, basically?
Well, there are, of course, the obvious places that people talk about, the big hyperscalers being able to recommend with much more accuracy and targets. Companies like Amazon, Google, using these tools to improve their recommenders. However, one of the, I guess, two big new opportunities that have emerged in the market unexpectedly in 2023 and are accelerating into 2024. One would be the healthcare industry, where companies are using this technology for much faster drug development times. And then also we've seen an extraordinary interest in sovereigns. Countries coming in saying, we want our own version of ChatGPT in our own native language. They have their own sets of concerns with regards to oversight that they can then control. And they are looking for U.S. counterparts to enable them to bring these technologies to the market.
How about the cyber angle of all of this? Because it felt like that was a real tailwind for cyber stocks as well, and then you get the earnings of Palo Alto Networks and everyone's worried that they're not going to factor in as quickly as people had anticipated. Are there any parts of the technology space that you think is overdone or the valuations aren't attractive right now?
Well, what we're seeing at Jennison is a real tale of haves and have-nots. Those companies that are bringing technologies to the table that are truly disrupting the industries that they are in, and those companies that may be facing challenges over the longer period, particularly with regards to pricing. People talk about, for example, as you mentioned, cybersecurity. There's so many different flavors of where cybersecurity exists, whether it's in the end market in your phone or your computer, whether it's in your enterprise, or even whether it's within the internet. So one really has to be very careful in looking at the various players, where they exist, whether or not they have pricing power, and the sustainability of that pricing power over a longer period of time.
Is your focus about the US being the outperformer here when it comes to tech? There's been a lot of ongoing narrative as to whether China's ahead with AI or US, and it feels as though the US still is. But where is the global opportunity? Because as we referenced at the top of the show, like European stocks are a record high on the back of this. Japanese stocks managed to go on a record high, and all of us are factoring in AI because of that.
I think that the answer to this question is that the predominance of the opportunities that we see are in the United States. However, there are incredible opportunities overseas as well. For example, ASM Lithography has a dominating position in the area of lithography. This is an essential, you cannot get around it in using this tool to make the next generation of semiconductors as well as the older generation of semiconductors. This company is an incredibly innovative company, which is reflected in its margin profile, gross profit margins, operating margins, free cash flow margins. And so we do find opportunities overseas as well, but the majority of the innovation that we're seeing is in the United States today.
It's just been fantastic having your voice, your expertise on the show. Thank you. Come back, have a wonderful weekend. Erica Clow, she's portfolio manager for the PGIM Jennison Technology Fund, really taking us through all the big hitters of the week. Meanwhile, coming up, well, another big hitter, which eventually might become public, Reddit. It's filing for its IPO. All the details on this company that's long been waiting to get into the public markets. Meanwhile, let's go to those public markets. Check in on what's happening with Walmart, up 0.6%. We're basically seeing flat, though, on the company that it's looking to be acquiring at 10.99 Vizio Holdings. Of course, Walmart's acquisition of Vizio is a warning bell, according to Massachusetts Democrat Elizabeth Warren. She's putting this in a post on social media platform X. In fact, regulators should scrutinize this merger, and they will potentially be looking as to whether it will extend Walmart's dominance, potentially threaten competition, she says. Remember, Walmart also gained on some strong results earlier in the week. This is Bloomberg Technology. talk about potential IPOs. San Francisco-based social media company Reddit. It has publicly filed for that IPO, long awaited. And of course, it's going to be a big test for VC-backed tech IPOs for the year. Here to break down what we now know from the S1 filing, Bloomberg's Katie Roof, who you've been tracking this closely, waiting with bated breath, and we have ultimately got to grips with the fact that this company is not yet profitable.
That's true. That's right. They reported they have over $800 million in annual revenue, but they are not profitable. They lost less than $100 million last year. Their losses are shrinking and their revenue is growing, but not profitable. They are hoping that this new AI partnership is going to be what excites Wall Street. They have a partnership with Google, and they're thinking that this is the time to announce that, this Google partnership that's going to scrape some of their data from Reddit will excite.
And we'll see whether, of course, that extends to other large language models, most notably OpenAI, where we understand now that Sam Altman, who was a temporary CEO for the company, is, of course, a big shareholder. But Katie, remind us who is going to be winning. Whether or not they win, remember this is kind of a down round compared to its last money in from VCs at a $10 billion valuation. But are we anticipating some good liquidity events for some key VC names out there?
Well, so Bloomberg has reported that they might just be valued about $5 billion when they go public, although it remains to be seen because a lot of this just gets decided the night before based on how the market is trading. They have, it's interesting because they've been around since 2005, so some of their early shareholders are no longer major investors. Condé Nast, actually, they've been a major shareholder in Reddit, and so this has been a long time coming for their investment. But you look at some of the early names, like a founder, Alexis Ohanian, he wasn't even on the prospectus. He did not make the cut for a 5% shareholder, which is what it's required to see in the filing. So, at this point, since Reddit's been around 19 years, I would imagine a lot of the original shareholders actually sold shares on the secondary markets and got some early liquidity before the actual liquidity event.
Advance Magazine publishes, as you say, the Newhouse family behind Condé Nast and plenty of other publishing set to be a key earner in this particular event. We thank you, Katie Roof, for just breaking down the intricacies of what's going on. Let's get into, that secondary market, how active it is, how positive it is on Reddit, getting to any sort of anywhere near a $5 billion valuation. We've got Brianne Lynch with us, head of Market Insight at EquityZen, which connects shareholders of private companies with investors seeking alternative investments. And just how active has Reddit been in the secondary market?
Reddit has definitely been a popular name in the secondary market over the years. As Katie said, this is a 19-year-old company, so there has been a lot of demand for liquidity from early shareholders over time. We know they did a tender offer in 2021, so I think that helped alleviate maybe some of that liquidity need, but I think there's still a lot of demand for liquidity that will come, via the IPO. But what we've seen from, trades that have been reported recently in the secondary market is about a $4.5 or $4.8 billion valuation. So the fact that they're eyeing a $5 billion valuation kind of makes sense, since companies tend to trade at a discount in the private markets where you don't have that same liquidity that you do in the public markets.
Who, if you can garner this at all from the activity in the secondary market, is this going to be a retail name, given, Reddit became synonymous with meme stock investing because of Wall Street bets? Is it more likely to be bought by a retail investor? Will institutional players be interested in a company that isn't yet posting profits?
I think they're really betting on there being retail interest in this name, or, in their S1, they even say as a risk factor, the fact that there is retail interest, or they expect retail interest, is going to cause volatility in the stock. The fact that they are issuing shares to 75,000 power users, or allowing those users to buy into the IPO, will also create some volatility, since there's no lockup to those shares. They're going to allow those shares to trade freely. So I think they're expecting a lot of retail activity, which is likely to increase the volatility of the stock, especially in its early days. From an institutional investor perspective, I think you're right. We've seen over time that institutions are less interested in these unprofitable companies. And Reddit is interesting because while they are a 19-year-old business, they really didn't start monetizing until 2018. So their monetization engine is relatively young and unproven, and advertising is 98% of that engine now, and there are opportunities for them on the data licensing front. As Katie mentioned, the Google partnership they talked about this week. But a lot of that is very forward-looking and unproven. So I'm curious to see how institutions, take that into account.
And Steve Huffman, having been there at its birth in 2005, still driving that new iteration of Reddit. And where is the risk factor in cozying up with large language model makers, with the big tech firms that want to scrape the data?
Yeah, we've heard this from the Reddit community that there has been some pushback about this and concern, but it really is these human conversations that are needed to train these models. And Reddit has, billions of posts and comments on its platform that are the exact types of posts and comments that will help train those models. So I think there could be a little backlash from users on the platform, but it is a huge monetization opportunity. At the $60 million contract they're talking about with Google, that only makes up about 7.5% of their current revenue. But if this is something that they can replicate with others, it could become a much more sizable part of their business. But an interesting thing that they do note is that these language learning models could also hinder their business. So if people go to ChatGPT instead of Reddit to ask whatever question they'd ask on Reddit may lose daily active users, and that's really going to hurt their ad revenue in the end. So it's a double-edged sword.
Well said. Brianne, I'm interested in that advertising focus. Ultimately, when analysts go out there and try to decide whose Reddit's competitors are they immediately going to be looking to Alphabet, to Meta, to other social media platforms?
I think those are the obvious, competitors in the space, and this market has gotten a lot more competitive as ad dollars have been pulled back. What Reddit is really trying to sell investors on is the fact that they can allow advertisers to reach a much more niche target audience. So, you're a sleeping bag manufacturer, you want to talk to people who are camping, we have a conversation of thousands of people who are specifically talking about this and their ability to actually convert people. From their own research, they've shown that 61% of their users say they're more likely to trust an ad that comes from Reddit. So if that can be proven in the clicks and the impressions that these ads get, they may have a bit of an edge, even though their audience is much smaller than these other platforms. But I think we're still early in proving that out.
Trying to be proving out the niche factor and whether that's a draw. Brianne Lynch, really great to catch up with you. Thank you from EquityZen. We've got some, activity there for that second